Now, if we're looking at interest rates, somebody asked the question of when do you see housing reaching the bottom? And we're going to talk about residential housing. It'd be easier to differentiate. Just go through residential housing. And looking at refinancing rates that are already low, do you see them going lower from here?
I don't. Remember we showed that Treasury bond channel, and the low end of that channel is somewhere close to 2.4%, and we just got to 2.5% last week. So I had a friend call me up and say, "Gosh, I've got an offer to refinance my house. Do you think it's a good deal?" I said, "Yes, do it now." Bond rates could go and mortgage rates could go a little lower near term, probably in the next month or two, and that's it. They're likely, even in that channel, even if we stayed in that channel, you would expect a bounce up to well over 4% in Treasury bonds, which means, well over 6%, 6, maybe 7% in mortgages again. And we could break out of that channel if we have a significant inflation trend. So even that channel would almost suggest a moderate recovery if we stayed in that channel, but we could also break out. So bond rates should go up. So now's a good time to refinance if people trying to get out of short-term rates into long-term. And we don't see housing really bottoming until late 2012 at the earliest, and probably more like early to mid-2013. So you shouldn't be looking to buy homes until then, and you should expect interest rates to come back down that cycle. Interest rates should come up into, let's say, early 2010, give or take, and then they should start coming down when we do actually enter what we think is the real depression, the real deflation stage. So interest rates will come back down, and they will end up lower. I think the 10-year Treasury we're going to see at least a 2% 10-year Treasury by 2012 or 13. So that'll be another time to refinance at lower rates. And in the best of all worlds is to buy a McMansion 70% off in Florida, on a 3.5–4% mortgage in late 2012, early 2013.
Okay. Now, Australia. I've got a number of people who are on this call from other areas of the world, and had several questions on what do you think is going to happen overall with Australia. I know you've done some work in that area, and you've had a company that I think you're speaking again for next spring from Australia. Is their market the same as ours, ahead, behind? What do you think is going on there?
It's similar, like most Western countries, similar baby boom peak, similar standard of living. The difference is that Australia, kind of like Canada over here, is more resource dependent, especially for exports. So Australia has taken a strong hit, obviously, here recently, like the United States, because of the meltdown. But in their case, their banking system is not in as much trouble. It's more the fact that commodity prices have dropped. If we see this type of commodity-led rebound that we're talking about, Australian markets should outperform. That'd be another good place to be, along with emerging markets or Asian markets. I think Australia will do well in this boom if it's commodity-led, as we expect. The problem is that commodity cycle is due to peak long-term. And again, when it peaks long-term by, say, early 2010, give or take. So when we go into this next downturn, deflation is going to hurt everybody, United States, Australia, et cetera, and even emerging countries at first.
And Canada?
Australia, in Canada. But Australia is going to get hit going to get hit stronger because of the commodity crash.
Mm-hmm. Okay. And Canada, I assume, kind of goes along with that. They're not as young as Australia, but they have the same huge percentage of their GDP focused on natural resources.
Yes, they do. Canada's like that. This commodity boom favors them, disfavors them. So that 29 to 30-year commodity cycle is much more important to Australia and Canada and most emerging countries, obviously, than it is the United States or Europe or even China, because China is more of an importer than a creator of commodities.
Now, talking about China, what do you think of the BRIC countries, with Brazil, Russia, India, and China?
Well, first of all, with the exception of Russia, the emerging countries in Asia, Latin America, Middle East, Africa, et cetera, they all have very strong demographics for many decades to come. The problem is they are strongly export-oriented and depend on the wealthy countries that are all going to head down strongly in this depression. So they will get hit at first, but they will bounce back quicker because they do have the demographics. And in the countries that are more commodity-oriented, like, say, Brazil or Russia, are going to get hit harder than the ones that aren't so commodity-oriented as exports as China, say, and India or parts of Asia. So, again, there's two cycles at work here, and some countries are more, the developed, wealthy countries are more subject to the 40-year demographic cycle, and in the emerging countries and the commodity and resource-oriented countries will be impacted as much or more by this commodity bust. But they are both going to happen kind of at the same time. It's just we would be looking when we think stocks have started to bottom, say between late 2010 and mid to late 2012, we want to buy back into areas like healthcare here that still have strong demographics behind them, in addition to the natural rebound from being oversold. And we want to buy into the countries that are not commodity-oriented, that have strong demographics, and that would be places like China and India.
Okay. And somebody had mentioned, I want to clarify this, somebody asked a question because we talked about using tips. In the economy, investing right now using tip bonds that are obviously Treasury inflation protected securities, and they said, won't those do poorly in a downturn or a deflationary period? Yes, they will, but what we're talking about is you do that right now as we're moving toward that last piece of inflation or push up in interest rates before you get to the deflationary cycle. So
yeah, that is good. That's an important point Rodney's making, because everybody thinks, okay, you buy high quality bonds, and what our research has continually showed in the last few years, looking at every commodity bust and every depression in history, is that bond yields peak because of credit quality. When the downturn looked so bad as it did in 1931, bond yields, Treasury bond yields, actually spiked up higher than they were in 1929 ahead of the crash in the downturn, because people are thinking, oh my gosh, even the U.S. government may not be able to pay back their obligations. And believe me, we're going to hit that this time. So what you have to do is, between now and then, yes, you have to either be in cash or inflation-protected treasuries, because we are likely to see inflation before we see deflation. And again, for more aggressive investors, you can be in the more aggressive stocks and the best in commodities. So yes, you want to be there, and you don't want to lock in. You want to go from these tips to normal, say 30-year Treasury bonds, probably around early to mid 2010. I mean, we're going to be monitoring for that, but that's what we would expect in the cycle, that we're going to have to get into this next downturn, and people are going to have to see the hair raise up on their neck, and then you buy the bonds when they spike, and then you lock them in, and then you tend to see bond yields fall for years. They fell from, I think, late 31 into 1942, the best bull market in bonds in history.
Now, we're coming back to real estate for just a second. If somebody had a piece of real estate, they own a home, they were thinking about selling it in the next couple of years, what would you tell them?
Yeah, you basically have the spring and summer of 2009 from my point of view. Maybe a little longer if you're lucky. In other words, and I don't expect real estate to bounce much, because there's still a lot of inventory overhang, but this stimulus and signs of recovery at first, I think real estate prices could start to flatten out and maybe even come back in some areas. We're saying you have a limited amount of time. I mean, we warn people, and everybody on newsletter know, we warn people up and down before the real estate peak. In 2003 and 2004, it was coming earlier because of the demographic cycle, and most people still didn't believe us. Now people know real estate can go down. Now we're saying, now that you know how bad it can be, we're halfway there at best, and probably not even quite halfway there on falls in real estate prices. So yes, use this recovery to sell real estate that you wish you'd sold before, or you're thinking of selling in the future. Don't say, hey, I want to move to Montana 3 years from now, I'm going to sell it then. You better sell your house now, because it's not going to be worth much if you wait 2 or 3 years.